Okay. Let me know if you can all see my screen. If that's all right. If one of you could confirm if my screen is okay to is visible to all.
Yep, can see it.
Sweet. Right. Okay. I just want to get some disclaimers out of the way. This is not financial advice. It's mostly for educational purposes only. Try to express my opinions across, as well as try to raise the general level of financial education amongst my peers. So that's the point I want to get across with that. Oh, all right, that becomes visible as well. Anyways, yeah, I just want to educate everyone around me so that they can make better financial decisions in their lives, hopefully. And content is being recorded so that it can later be posted for YouTube, so people can review it later when they need to or have to, or for people who aren't here right now. Yeah, so the idea of this was also to try to bring up ideas or to encourage my peers to try to speak more about financial decisions or ideas in their lives of what they're doing with their money or what they can do better with their money or what we as a collective can discuss going forwards. um, this takes mostly a passive investment approach, but I'm going to try to be as objective as possible, wherein I will be contradicting myself, as I tend to see myself moving more towards the active side of things. Just because I've been reading and learning about how I can leverage my age. I'm still young. I'm 26, so I can still. I've got time to make up any losses that I may make in my own journey. So I'm transitioning from a pure passive, which was 3 months ago, 5 months ago, 6 months ago, more towards a majority active, while still having things in my ISA, which is basically a UK based tax deference or tax free allowance account that British nationals or British residents have. Right, so let's crack on. I have pressed enter, but nothing's happening. Oops. Okay, I guess my mouse swipes it is. So this is the first of 8 podcasts or episodes or whatever you want to call them. I still don't know what they are. I'm still learning along with you all. And this is setting the very basic ground rules. This is trying to get everybody up to level 1. Most of these 8 or all of these 8 episodes are aimed towards trying to get uh, a lot of you people onto trying to get you all on a level playing field so that you are aware of the most common. Ooh, got a sweet. You're right. Sweet. Okay. Yeah, try to get most of you all up to some sort of level where you can begin to understand the jargon that goes around in in the world of investing, so to speak. Yep. So that's what I want to get across. Second one will be more about the mechanics of the stock market, which is basically how, if you're trading stocks, what you can expect to have around you, because it's not as simple as buy and sell. You're buying and selling to someone. So you need to understand the concept of that is actually happening behind the screen or the button that you're pressing. The third part, we're going to go into the metrics and overview of individual stocks. So, things that you will often hear, PE, EPS, stuff like that. And if all of that goes over your head, we're going to skip straight to the fourth one. When I say fourth one, I mean fourth episode, which discusses market indexes, which you can often hear, like the S&P 500 is a very famous one, the NASDAQ 100, the FTSE 100, for example, and so on and so forth. I'm just going to explain what they are, what purpose they serve, and why I think they're a boon and a curse. After that, we're going to discuss funds which actually track these indexes. So when your friend tells you, "Oh, I just bought a share of the S&P 500," you're not actually buying a share of the index. You're actually buying an ETF, which we'll talk about later, exchange traded funds, which tracks or attempts to track the index. So that's what we're going to discuss in that particular episode. Then we're going to go on to my favorite part and what I love to focus on, which is derivatives, because that is just a whole new level, a whole new playing field. It's an amazing um, aspect to finance, which very few people take into consideration, or some even take for granted because they don't understand it. Air quotes. So we're going to discuss the most common and available options, well, available choices to investors, which include CFDs, options, most in the US, but also some in the UK, futures and swaps, which is made famous by the crash of 2008. Then we were just going to have an overview of the entire course in episode number 7, where we're going to try to put our money to work and see how we can begin to understand, how we can begin to analyze certain aspects and see where it's best best suited to drop our little funds in. And lastly, we're going to discuss the flip side, because there's always going to be a crash. If you look at the history of time of the stock market or any even the economies, there's always been periodic, although they're more random, crashes that happen over and over again, and they will happen. It's how best we can prepare for it, or hedge for it, so to speak. More about that will be mentioned later on. So that's what the 8 episodes is. The aim is, the first 8 episodes is what I think you need to know or would want to know. Whereas I'm hoping to get ideas and feedback from you guys. Most of you know me personally via social, so just send me a message, talk to me in person, and the next 5, next 3, 4, whatever, I can dig deeper into why I do what I do, why I think the way I think, or why, if you want to discuss any particular instrument, we can go forward and do that. I am not going to be discussing specifics. So if you tell me, Jack, I've got like 500 quid, or Jack, I've got like 3 grand or whatever, what I do with the money, I'm not going to discuss that in any of these, or even in person to you. I'm going to tell you what I think you can do, but it's just a no from me. So it's going to be a more generic overview. I'm going to try to teach you to fend for yourselves, and then you can make an educated decision on where you want to risk your money. And risk is the correct word here, because investing is all about risk and reward. You're basically betting something to win something. So I'm not going to be afraid of using the word risk and reward here, because and even I'm using the word gambling loosely, but in effect it is well, it's better than the odds you face at the casinos, let's just say that. Right. Cool. So, as promised, I'm going to set an idea of why we need to invest. The basic idea of any investment, air quotes, is to deposit our funds or our cash in something so that it grows as time passes, beyond the erosion of the costs, taxes, and inflation itself. You want your final, your final outcome, be it 5 years down the road, 10 years down the road, you want it to be worth more than the money you're going to be putting in now. You're hoping on future returns. This is more important than ever for the current generation, is because the previous generation before us, our parents, assuming most of us are in our 20s or 30s, even up to our 40s, could rely, well, our parents could rely on state pension or their workplace pension, or they could rely on people to look after them. Even cash in the bank back then was a much more valuable asset to have. Well, asset is the wrong word here, but a much more valuable instrument to have, than what cash in the bank is worth now. You think about it. If you win a million quid in a lottery, it's sadly, it's a bit of a money, but it's not as much as you think. So there is a need to actually attach our cash to assets which we think would appreciate over time. And of course, we've got the benefit of compound interest. As I said, most of us are within our 20s and 30s. So we've got maybe a good 40, 50 years of life ahead of us, as a good estimate. And we've got compound interest. I don't know if you I studied compound interest in like fourth or fifth grade, and it's basically where the interest is applied to the principal accumulated up to the point every year. So in year one it's 100, and it's 5%. In year two you're getting interest on 105, and so on and so forth. So it's interest applied to the principal plus previously earned interest, as opposed to simple interest, which is just interest applied to the principal alone. It is quite marginal at first. I've actually started my own journey like maybe 6 months ago, and I'm like 4% up in my safe, quote safe, portfolio, which is quite peasanty, so to speak. But we'll chat about that again in 20 years, and that's I'm leaving that time to grow 30, 40 years from now, and let's see where that gets me to. Right. So most people assume, or they think like, I think I'm going to start investing when I have a grand in the bank, or 5 grand in the bank, or 10 grand in the bank. And when they get to that number, when they see their bank account being that number, they see a nice fancy thing, and they mostly just go for it, be a new watch, new car, new whatever it is, the next shiny new thing that they see. case in point are the iPhones. You must have a new one every year, for example, or every 2 years. I don't know. And that's and then they never really actually get around to it. They never really go around to getting their brokerage or their ISA, or in America it would be the Roth IRA, or something like that. Or yeah, I think it's the Roth IRA. They just never get around to building their portfolio, or thinking about, or even thinking about what they want in their portfolio, until they're like 50 or 45, and they're like, oh wow, my entire life's passed me by. I've got some money, but it's not enough. So what do I do now? The most important factor for compound interest, apart from a positive rate of return, is time itself, and that's, I think, the only two variables that affect compound interest. So obviously you want a positive return, because if it's negative returns, then why would anybody want to risk their money? And you do get negative returns in some cases, which we'll discuss at a later point, and also discuss diversification. I think it's called foreshadowing. Anyways, so just an example down there. If I drop in like 100 quid at a 5%, which is quite a realistic number given the last 10 years of the stock market after accounting for inflation, which is roughly 2%. And we will talk about inflation on the next slide, I believe. That's what 100%. Well, that's what 100%, 100 pounds over 5% would result in. Oh, my internet's being weird. Sorry about that. Right. So yeah, it doesn't sound like a lot, but in year 25, with simple interest, you'd end up with just 225 quid, which is 100 pounds of your principal, and 125 earned on interest. But with compound interest, that's almost 3 times that money. Um, well, you could almost say it's free money, but this is only if you do it once and never again. Now think about doing this regularly, weekly, monthly, annually. It doesn't matter. You're just adding more and more principal to it, and earning more and more interest on that. Apart from that, most of us, well, when I say invest, I'm not saying invest forever or unto the oblivion, or until you pass away or whatever. You're investing for a goal, be it your own retirement, maybe a marriage expense. I don't know if you want to get a fancy marriage sorted. Travel expenses, if you want to go traveling in 3 years time. 3 years is a very good horizon for you to invest for, or even 5 is like a good minimum. um, or be to support your children. By not investing early, you don't stand to lose the interest of the delay that you make. For example, in the case above, given a 5% increasing interest rate, you don't stand to lose 5 quid, which is, after year 105, at the point at year zero, or time zero, it's 100. You don't lose to stand the 5 quid. You stand to lose the very last bit of earning, which is when you withdraw the funds. That's what you stand to lose. And I know I can't explain this as clearly as a statement might put it, but I've also got an image to help you explain what I'm trying to say here. Uh, Looking at this picture, so this is just the earnings, not the cumulative principal plus interest, just the interest of a single $5,000 investment at 8%, which is, just a random number, just picked up, over 45 years. So of course, 8% of 5 grand is about $400. I'm going to say 400 quid, because I'm used to, speaking in pounds. So first year one, 400 pounds makes sense. Year two, you make 8% of 5,400. I think that's like 420, 430 quid, whatever. By year 45, you are making close to 14 grand, which is 3 times your initial investment. And remember, you're not actually adding any money in. This is one £5,000 deposit put in there, left to, grow, so to speak. What you stand to lose by not investing as early as possible is the very last bar. Of course, in your case, the bar may vary. The ideal scenario is, by the time you pass away, which is, completely arbitrary and, completely random, your account, you intend for your account to be zero. Either all the money has been used up for your living, or passed down to your children, or whatever, however you choose to, dispose of that money. That's the end goal. That's the perfect scenario. And as more of us live longer and longer, our grandparents lived up to 60, 65, 70. We are likely to live up to our 80s and 90s, given our lifestyle choices and the betterment of healthcare. Assuming we all stop working at 65, which is the current retirement age, you've got 25 years of expenses wherein you can't work to make up for that. That's where you're trying to use or leverage your age, which is the 45-year working period or 30-year or however long you want to work for. You want to leverage your age so that by the end of your working period, be it whenever, your assets and the interest they accumulate is enough to pay for your liabilities over the non-working period, which is the next 45 or the last 45, 35, 20 years of your living, so to speak. And you don't want to be frugal back then. You want to be as frugal as you can now. This is the concept of trying to pay yourself first. You are trying to pay your future self by investing as early and as often as you possibly can. Apart from that, I need to make it extremely clear the concept of cash was never meant to be an asset. It was only meant to be an intermediary that explains to everyone that 100 grams of bread would roughly be 100 grams of rice. And I checked this on Tesco like 20 minutes ago. So I know I'm somewhat correct. So rather than carrying, or bartering like we used to in the agricultural revolution or whatever, or me dragging my sheep to the market to swap for a car or a cart or whatever, I have cash, which is a fixed value as denominated by the government, that tells the bearer, that tells my payee that here's some money, here's some thing which you can use for whatever. I want to get some bread for my breakfast or whatever. Apart from that, cash has a reducing buying power caused by inflation. Now, what's inflation? As economies develop, as living conditions get better, as workers start to get better and receive more money for the jobs they do, um, the cost of doing business is going to increase. So obvious, as salaries are rising. Um, in addition to that, I mean, as a consequence of that, the products you as a consumer buy are also going to go up. And we've seen that looking at iPhones going from $300 or $400 when they first came out 10 years ago, uh, to like we're looking at four-figure iPhones now. So that is partly inflation, also partly greed, profit, whatever. And we can estimate that the UK government tries, or the Treasury tries to tries to mitigate or tries to limit inflation to be roughly 2% per annum. That's what we have to pay for our increasing for our improving quality of life. So assuming at 2%, if you've got £1 million in the bank in 2020, it's only worth, well, only, I say only, it's still a lot of money, but it's only worth about 680K 20 years from now. And as time passes, it's going to be worth less and less. It doesn't mean that your 1 million will corrode over time. It's just that 1 million today will buy something worth 680K today in 2040. I hope you can grasp the idea of that. And as I said previously, you need to find a way to attach your cash, which is your loose, your liquid net worth, to assets which are believed to appreciate over time. So the asset's value is believed to grow over time and give you a positive return after accounting for any expenses and costs, including but not limited to taxes, inflation, and other expenses. Right. Going on next. So, all of us as modern retail investors have a lot of opportunity around us as relative to what our parents, grandparents had. Uh, it's become extremely cheap, easy, and accessible to access a wide range of instruments. And when I'm talking about investing, I'm not limiting it to just the list over here, which I will go through in a minute. And this is a slide I think I'm going to spend the most time on. Fingers crossed. But assets could be anything. It could be, cars, which you think might appreciate. It might be your house if you think that's going to appreciate. And you've got art as well, which people view as assets. And we'll also discuss, crypto slash Bitcoin in a bit. But it's what you believe will appreciate over time and will give you a positive return, 5 years, 10 years, 50 years down the road. Right, going through this list, it's in no particular order. I tried to order it in ascending order of risk or an increasing order of risk, but it's just too, it's like a Venn diagram. There's just too many unions, which is the parts wherein they you know come together. Anyways, so we're going to discuss bonds. Bonds are basically IOUs given or issued by the government or corporations. Let's talk about government bonds. It's wherein the government asks you for 100 quid, it could be 100 quid bond, today, and then they will pay you over the next 10 years or 5 year or 20 years, depending on whatever duration you choose to buy the bond for. They will pay you an interest and a principal back. So you give your 100 today, and over the next 20 years, you are likely to get a steady income, either monthly, quarterly, or annually. That will be your principal plus the interest that the government promised you. As I said, this can be issued by the government or corporations as well. These are so corporate bonds are different from corporate stocks. We're going to discuss that in, I think, the next episode. So yeah, don't freak out yet. But yeah, these are like some of the safest. Well, depending on what government you go for, U.S. versus Zimbabwe are two different levels of risk. But they tend to be like the safe havens, wherein they tend to deflate or decrease in value very rarely over time. But also because of their limited risk, they also give a limited reward to their bond to the bond holder, so to speak. You've also got real estate, which can be houses. It could be private or commercial. So you could own piece of land and lease it out to different people. You've got either that's the physical form of it, or you can get exchange traded products. We will discuss that later. Just as a foresight, it's called REITs, REITs. That's the short form. And different REITs have different ideas. They're a lot like funds, so we'll talk about them later as well. You can also begin to invest in metals like gold, silver, platinum, or other precious commodity metals. These again could be physical, when you buy and hold gold through generations, or you get exchange traded products when you buy a share of a fund which holds gold in your name. And that's what I tend to do. You also got stocks, which are also called equities or securities, which are basically corporations selling a small portion, a fractional portion of themselves, which I will speak about later on. So that's the most common form of investments that people tend to gravitate towards. You've got funds, which could be a mixture of one or more of the above. You could have a mixture of stocks and call that a fund. You could have a mixture of all of stocks, metals, real estate, bonds, and just call it a whole market fund. And I think your most of your retirement funds would probably be a mixture of stocks and bonds, actually, with some real estate, just dropped in some cases. We can also talk about crypto, which is actually a very volatile asset class right now, which is quite volatile, but it's becoming more and more famous by the more and more popular by the day, by the week. I don't know. It's No one's going to know where Bitcoin's going to be, a month from now, but people are hoping it might go up, and that's one of the main reasons they're buying it. And finally, we've got derivatives, which are instruments you want to consider as downside protection, because most of the above you can only bet on going up. You can't bet on them going down unless you've got special privileges with your provider of these instruments, which we will call a broker later. Derivatives are instruments that individuals can access, and we will talk about that later. Can access to give you downside protection in case of a crash. You pay to protect the tail risk events, which will happen once in a while, like we had in 2020. But when it does happen, your portfolio won't be down as much as somebody who hasn't got some sort of hedge protection uh, for themselves. Just as a side note, I see all these robo apps, coming up in ads, and they're like, "Oh, invest with us," and you slide across a slider, and it creates a portfolio for you. um, I would advise against thinking twice before going for these, not because they're a scam or anything, but because they will give you market returns, which is the return equivalent to what the market would give you. When I say market, I'm talking about index funds, would give you, but they cost an awful lot, like maybe 3 or 4 times the last I checked. So, uh, it may not sound a lot, but when you put it over 40 years, chipping away 0.4% or 0.6% at your portfolio isn't going to be as much as chipping 0.15 in the case of Vanguard, for example, or 0% in the case of my broker in this case. Right, so that's next. We're just gonna try and close up with a very basic idea of how people tend to invest. You got two camps, so to speak. One is people who just decide on what they want to invest in. They try to collate their ideas into what they believe in. For example, like ESG funds, which are like environmentally, socially governed funds. So they don't invest in toxic materials like weapons, for example, or alcohol, or smoking goods, for example. They also, or some people just want the whole market return, so they will diversify as much as possible and find a fund that does that. So most investors will spend a couple of hours doing their research, maybe 10, 20 hours, do their research. They will be, they will have good conviction of the idea, and they will pick that fund and stick to it in perpetuity. They'll just keep contributing periodically, monthly, weekly, whatever they choose to do. And every 6, 10, 15 years, they'll have a think again. They're like, is it what I want? And then they'll change the strategy if need be. But a few more people choose the active approach, wherein they try to constantly find better products, or instruments that will help them get to their goals sooner. They also actively dabble in the instruments that I previously mentioned. So they will, remove crypto, add a stock, remove a REIT, add something else. Play with bonds if they have to, if they see opportunity. These people are constantly looking for opportunities in the market that they can utilize for better returns. Um, as I said, I'm going to try to be as objective as possible, and they both have their pros and cons. And history would say passive investing is perfect. If you look at the YouTube videos, it'll say if you invested in a passive fund over the last 15 years, you probably would have beaten most index investors, or most active investors. Sorry, but what you don't, the other side of the coin is there's been a bull market for the last 15 years. A bull market is where assets have been appreciating. So a positive movement is bullish. So if I say I'm bullish on Apple, it means I'm assuming or I'm hoping Apple will go up in price, the stock of Apple, that is. So we've had a bull market for the last, 10 years now, since 2008. There really hasn't been a bear market. A bear market, as in where the market is down and stays down. We had a crash and we were back up within a year. That's nothing compared to what we experienced, well, what the Americans experienced in the 2000s. If you Google the lost decade, take a few seconds, Google it up. The lost decade is when the US large caps, which is the largest companies in the US, went nowhere for 10 years between 2000 and 2009. Or even worse is the Nikkei, which is the Japanese stock market. The Nikkei 225, I think, is the index. That index or that market crashed in the 90s because of the hype or the bubble that was forming back then. And it only recovered. I just saw like 2 weeks ago, I think 2 Thursdays ago, is when the Nikkei hit 30,000 again after 30 years. So what do you do in these cases wherein the market stays down? Active investors tend to, they know what they can utilize to go forwards, to try to even make money in bear markets, utilizing derivatives or inverse funds, or whatever it is at their disposal. So, just to sum up what we spoke a while ago, the idea is you try to set an investment goal or a milestone. What are you investing for? It'll be your children, your retirement, some sort of event happening a couple of years down the road. Then you spend a few hours researching funds, or stocks, or crypto, or anything that you think will suit your investment needs to help you get to your goals. How much you need in X amount of years, how much you're capable of putting aside today, and what instruments can help you get to your goal as quickly or as efficiently or as risk free. It could be any of these. It's a risk reward trade off to get to your goal as XYZ as possible. Then you begin to contribute towards your goals. You try to drip your money in. Could be weekly, monthly, annually. It's totally up to you. Lump sum, a grand is lump sum, or 100 quid every month. It's totally up to you. Sorry. And you would need to rebalance, which is basically, if you were in the depth of the 2020 crash, and you had some bond, like if you had a fixed portfolio ratio of 90% stocks and 10% bonds, you would see that in the depth, in the deepest, which was in 23rd of March, I believe, the deepest point of stocks in March of 2020, you would see that your equity portfolio would be roughly 80% of your total portfolio, and bonds would have inflated to 20, in which case, when you want to rebalance, you would have sold off your excess bonds and repurchased, or rather purchased, some equities to balance and bring it back to 90-10, the ratio you originally intended, the strategy you wanted. And you do want to try to rebalance at least once a year. That's a good time to rebalance if you think it's suitable for you. And then you just sit back and relax. You could automate this in some cases, or in some cases you physically have to go in and invest. It depends entirely on the instruments you choose and what you want to achieve. And then next thing you know, you wake up one day 10 years, 5 years down the road, and voila, you've got the number you wanted all those days ago, or all those weeks ago, or all those years ago, and you're there. So I think that was about it. Yes, I'd like to end with just a quote that I think would be apt for what I want to get across. And I think each of these episodes have their own quotes, which I either found interesting, or funny, or whatever. And this will be uploaded to YouTube for anybody who is missed. And I know a few people want to be here but cannot. And these slides will also be uploaded in the YouTube link later on, so don't worry about it. I will export the PDF away, and you will get a link in case you missed anything. I've also attached a few references that will help you get started. Again, these are, Yahoo Finance and Morningstar are basically just instruments to help you find instruments. But the rest, I mean, even Track Insider is like Yahoo Finance, is to find the correct fund or the stock or whatever. But the top four right now are to try to get the concepts across to you so that you can begin reading. Because obviously, I'm trying to compress hundreds of hours of knowledge of what I've learned so far into 4 hours of podcasts, or in this case just presentation, which is not justice to the knowledge that I'm trying to pass across. I'd encourage reading on these. Now, most of these, again, try to focus on passive investment. And while I'm not an opponent of it, I'm also not completely a proponent of it. Having stated, we've got our age to leverage and try to utilize to get better than market returns. At least have a try if we can. You're not obligated to. So, investing into passive funds, which we'll speak about later, is the bare minimum you can do. But as young people, we can add to that. Yeah, people say you can't beat the market, and that's somewhat true. Over 20 years, yeah, you can't. But on an annual basis, on a monthly basis, on a 5-year basis, you can quite beat the market, or you can challenge the market to beat you, as I'm going to discuss, I think, in episode 6 when we talk about options, because that's challenging the market to beat you, as opposed to the other way around. I think that's about it. Yeah. So that was episode 1. All of them will be about this length. I'm trying to hope for 25 minutes of me just yapping around, and that gives you about 5 minutes. If you've got any questions, rather than unmuting yourselves, I would recommend just put it in chat so everybody can see it. Or if you want to unmute yourselves, try to not speak over anybody else. So yeah, I won't be discussing future episodes right now because that just ruins it. But if you got any questions so far, feel free to shoot them now. Else, I think I'll just stop this meeting. And most of you personally know me anyway, so just catch me for a few seconds on either socials or in person, and we can discuss further if you want to. Yeah, so I'm just going to hang around for a few more minutes. I think Zoom gives me 40 minutes for free anyways, so I've got less than 5 minutes. Any questions? Just shoot them across in chat. I'm going to try to open the chat window. I'm absolute boomer when it comes to technology, so bear with me. Oh, there we go. Yep, I guess yeah, this is okay. I guess I was quite clear in what I said, which is a first. Thanks, guys. If there's anything else I can help with, just give me a shout whenever. And yeah, I think I'm going to wrap up here. Cool. Thank you, and have a good night. And then thanks for your time. I really appreciate you giving me your time so far. I know it's late, but yeah, thanks for checking in, guys. Cheers. Yep. Thank you. Bye bye.
Is it?
Oh, hello.
You're still here.
Yeah, I'm still here. Well, we're all still here. I'll just stop sharing.
It sounded like you were leaving.
Okay, fine.
Thanks, Jackie. That was good.
Yes. Thanks. Bye bye.